We are so excited to be here and to share our expertise. We're going to begin with introductions, and I would like for you to introduce yourself, talk about your businesses, and then we'll lead right directly into our question. Okay, we'll start with you. Richard.
Morning, everybody. Sorry it's such an early start to the day, but it's been a fantastic conference so far, and I'm really privileged to be here along with my esteemed panelists to talk about this subject. So, a little bit about me. So I started my first business when I was 6 years old. I had my first team when I was 7. Happened to be my brother and sister, so it's slightly press-ganged into it. But and during the course of a few years since then, have worked in big corporations, banks, international advertising firms, as well as a whole raft of different startups, some which have been successful, others which have been spectacularly unsuccessful. So throughout that, I've sort of curated a set of experiences which have all kind of landed in this business which I'm doing now, which is called Pixie. And the whole concept of Pixie is that that we have been able to break down the patterns of decision-making and behaviours that companies that have successfully scaled, and I mean scaled to around a sort of Series A type, valuation, and that decoding has allowed us to. I'm getting feedback. That's all. Okay, fine. And that decoding has allowed us to effectively create what we call a sort of startup a DNA. It allows us to index individual startups against that DNA and assess their potential to successfully scale up. And then we can help them then with a whole range of data-driven decisions to improve their chances of being successful. So that's kind of where I am, with and without a microphone, sometimes.
Thank you, Richard. Thank you, Richard. Now we'll have our next panelist.
Good morning, everyone. My name is Prajakta Marwa. I am it's a lot of industries throughout my life I have worked, like from trading to tourism to marketing. And I will try to keep as a founder's perspective more than an investor's perspective. Though, most of the businesses, I am only the investor. So it will be a little difficult for me to differentiate between investor's mindset and founder's mindset. But we'll try to keep it from founder's mindset. Let's see how, it's not only the different industries, it's different continents I have worked. So maybe that perspective, the way different cultures, can change the mindset of founders or investor, I can add value to that. And I'm looking forward for this. Let's see. Thank you so much.
You're welcome.
My name is Paul William Baird Sr. I'm the chairman and CEO of Baird Enterprises Incorporated, which is the umbrella for 7 companies. I have 4 launch pads. Consulting I've been doing consulting for over 40 years. Then we have a media launch pad, which consists of 2 companies, Creating Possibility Television Network, which is a streaming channel. And then we have Beam Me Network, which deals with Beam Labs, Beam Studios, and Beam Agency, where we produce animation, docu-series, full-length movies, and we assist content creators with protecting their intellectual property and creating money funnels. The 3rd launch pad is real estate development, building sustainable communities where people live, work, and play. And the 4th one is a nonprofit entitled Fortune 7, whose mission is to eradicate the economic inequality caused by systemic racism through entrepreneurship, creating multi-million-dollar businesses, leaving legacies for their children and children's children. So I consider myself as a serial entrepreneur, and I'm always in the space of raising capital. And my perspective would be on seed capital, how to get that money to build the momentum.
All right, thank you, panelists. I would like to just talk about myself just for a few moments. I'm founder, CEO, and principal of a charter school in Florida, where we serve students with disabilities from pre-K all the way to 12th grade. So the majority of my funding comes from state dollars and enrollment. So having to manage enrollment, the ups and downs of enrollment, and how that impacts the operating cost. I just finished an $8.5 million building facility for our school, and so proud of that. But I had to go through different funding challenges, and so, well, thank you. And so understanding the dynamics when it comes to even, building a facility this large. And so this is a very engaging and exciting topic for me, and I hope it is for you as well. So I would like to take a poll of the audience. How many of you in here today are startup companies, or you're looking to start a business? Okay, great. So this information is going to be very beneficial to you. How many of you have experienced businesses and you're maybe looking to expand? Okay, so great. So this will definitely be beneficial for all of us. And so let's begin. So seed to Series C. So let's begin with defining what Series A is before we even get to C. Does anyone want to take a stab at it?
So,
Mike.
I think before we get to Series A, we had to do that seed capital
Okay.
to build the momentum. If that's okay.
Yeah, that's fine.
Okay.
Sure.
So,
Absolutely.
So the number one problem that most businesses have is that seed capital, and that's where you have to convince somebody that your idea or product makes sense and will make money. And the challenge, I've served as the economic development specialist for the city of Muncie for 10 years. So I was on the public side assisting businesses to get that seed capital. And so that's the floor in what you have to do in order to get the business started. So there's three things that I discovered about that phase, the seed capital. One, most entrepreneurs don't know how much money they really need.
Right.
They always get too little money. When I was 22, I got $250,000, thought that was a lot of money until I bought equipment. Then I had 21 employees. How many know that $250,000 was gone like that? And so, and not having a coach, someone that assists me to take me through the process. The second thing is not understanding how much money you have to burn through to get to profitability. And that goes back to the first one, not having enough money. And the third challenge is to have the founder go out and raise capital. How many find that challenging to go out and ask other people for money? I would tell you right now, they're not going to give to your CFO or anybody else. They're going to invest in your vision, and you have to be able to articulate it. And that's going to get you to get to Series A, B, and C. But the C capital stage is where you get to have the minimum viable product that demonstrates that your product or services has viability, that it makes sense, and that people want it.
So when we are approaching the bank or whatever the funding source is, you said the number one factor or issue from the start is not knowing how much money do you need. Yeah. So how do we find out how much money we need? Okay, so I love this question. Most, not all, but most founders think in little terms of money. And so I do an exercise in my consulting where I ask people to understand that money is just a number. So you have to get over the mindset that it's a lot of money that you're requesting and that people are going to say no. So you have to be willing to ask for what you believe is going to be what you need to get the business off the ground.
And I have to do a simple exercise. Can I demonstrate it?
Absolutely.
Okay, so I want you to say $1,000. Say $1,000.
$1,000.
Okay, say $1 million.
$1 million.
Say $1 billion.
$1 billion.
Do you know you use the same breath every time? It's the same breath. The only difference is your mindset about how much money that is. And if it's your first business, you think $1 million is a lot of money. And so the burn rate that it takes for you to get from startup to viability is going to determine how much money you need. So you're going to have to look at, if it's a service and you pay, and it's a cash business, then your burn rate is going to be less than it is doing a product or service. And that's where you have to get coaching from the SBA, some other agencies, and other people that help you walk through those numbers.
Thank you.
Yeah, I would like to add to this, like, at a different level, we are looking at different things, at seeds funding, the focus is on idea validation or the product validation. So the funding will be, we can structure it accordingly. In the Series A, we are looking at repeated business and the scalability of the business. So depending on the vision, so we are not investing at seed or series, we are not investing in the business. The founder is looking for the larger vision. So we need to project it like that to understand what kind of, is your vision or where you are looking at, because is it are you looking only for 100 people, 1,000 people, or a different continent? So budget is very subjective depending on your scalability. So that's how I will look at this.
Richard, would you like that?
Yeah, I think about this this concept of a series of capital raises is quite interesting because first of all it depends on which part of the world you're in, because raising capital is very different in even different countries. The UK is quite different, for example, from, say, raising capital here, or even dramatically different from raising capital in, say, continental Africa. But also it's the evolution of the idea. I think we were just talking here about how validation is so important. I mean, in my experience, it's particularly if it's a tech-driven business or it's a business which isn't particularly built around bricks and mortar. There's a very high probability that the idea which raises the initial capital will not be the idea that raises the big capital, because things evolve and you iterate and you pivot. And this is why the team is so important, because I think the earlier the investors are involved in the process, the more they're looking at the team rather than necessarily the actual product. I mean, Pixie. I mean, I could talk all day about the trillions of dollars the market potentially occupies for us. But at the end of the day, we're still building through the validation of the framework of that product, and it wouldn't be at all surprised if I was sitting here talking to you, say, in 12 months' time, and I was showing you a different version of what we think we're building right now. So there is a fluidity to this. I think the team component is so important, and I think investors look for as much as a team that they believe can execute as they do with the fact that there's an idea and a vision that they can exploit and open up the opportunity for.
Can I piggyback?
Yes,
on
go right ahead.
So Richard just pointed out what happens when you move from the founders. You have to have a system in place, to have a team in place that's going to give the investor confidence that you can scale your business. When you're a founder, and usually we start out just by ourselves, maybe have a couple people, it's a different ballgame when you add a team. And that team has to have the capability to give the investor confidence that you can scale it. Now, I suffered from my first business when I got the $250,000. I suffered from something called the fast growth syndrome. I didn't have everything in place. I didn't have a team in place. And I killed the business because I grew too fast for the capacity to handle it. And that's the value of having a team, so you can scale it. And the investors are confident that you can maintain it.
That's important. Thank you for setting that foundation for us. So now, how do we move from seed money to Series A?
So shifting the momentum from seed, that means you have already validated the idea, and the idea is going to, it has the scalability. So it's very important to understand, the investor here is looking at what kind of growth or what kind of business you are going to give from that idea. So when we are shifting, there are a lot of things we need to take care, because this is a stage where we need to build our team. This is a stage where we need to build our systems, processes. So this kind of, if this processes, systems are there and scalability is there, then you should go to, Series A. If your idea is not validated, we should not try to do the transition.
Okay, so that leads me right into my next question. So the Series A proof point, okay? So when you're moving from seed to Series A, it's all about scalability, and you all have already mentioned that. What is the single most critical, non-negotiable metric of proof point a founder must nail to signal to Series A investors that they're ready to transition from a project to a business?
Is that minimum viable product. In the seed capital, you're testing to see if your product or service has an audience. People have great ideas, but nobody may not want it. So if going from seed to Series A is that you've already demonstrated, you have metrics that can show that there are people that want the product, need the product, and willing to buy it, and now you present an opportunity to scale it. And I think that's the most important thing.
Are there certain metrics that we need to be looking at, or does it vary by business?
It varies by business. Okay. Yeah.
I think you mentioned the magic word there, which is scale, and of course this is the moment when the business will transition from developing the MVP or the idea, or validating the market and building the team and all the other kind of infrastructure components of the business now need to be in place, and the Series A round probably is the time you're first going to encounter institutional investment.
Yes.
And this is kind of scary territory, because this is the big boys league. You were talking about a business that you'd created now, which will have a valuation of something in the order of about 50 million US. So people look at you very seriously. But the purpose of the seed round money will be for you to scale, and this takes you into a whole different world where particularly if you're a tech business, there's every probability you're going to be planning to lose money. And so the capital you're raising will be to fund that deliberate loss-making period as you occupy market space and you go to hyperscale. And that's why we find that this is a really stressful point for lots of startup businesses and for founders, because the BlackBerry story is the classic Hollywood version of this. The team that started the business and developed the concept and had the original idea probably isn't the team that's going to take it through this phase now. Doesn't make the original team bad people, it just means that we have to be very open-minded about the need to develop new skills and new resources, but particularly around how we scale the business and bring that into the fold alongside the original founders.
Yeah, and so what's happening, what he just demonstrated, is that when you're going from seed to Series A, there's a new language to money. There's a new accountability to explain to the investors what it is that you're showing capacity, and that goes back to the team and having that upgrade, elevation, and skill set in order to give them confidence that you can scale it and maintain it.
I will like to add one more point, which I think generally investors also look for. There should be repeatability in your business. Your $1 is bringing how many customers? Yes. And you should prove that, every month, so that there is a pattern to it. And then you understand, you require, if you are planning to have so much business, that's kind of an investment, or that's kind of the pattern which you need to follow to scale it. So you need to look that pattern. That's what I feel.
Thank you. You just completely explained what my business does. so these are patterns, and the companies that succeed and are successful in scaling have a habit of demonstrating similar patterns, and it's by learning from those that we think we can help every startup to some extent emulate those patterns, because this idea of having data-driven decision making that allows those decisions to be slightly improved at each point, we think can help all businesses be more successful as they go down the road towards successfully scaling up.
Yeah, so he just said something that goes back to the language. In the seed capital, it's not data-driven yet because you're still trying to prove it. But when you go to each level, that data becomes more powerful in terms demonstrating the viability of the investment. Data-driven. Now think about this. If you're a founder and you're not used to that, you're not hearing that, there's a whole education that has to take place, and you have to be coachable so you can go over to that next level.
So we're still talking about the early stages of funding. And during this stage, I have one question, then we're going to move on to the mid-stage focus, which is Series A to Series B. But what was the biggest hiring mistake you made in this transition that impacted your momentum?
If I have to say from my experience, I think few mistakes like, hiring little late and hiring wrong people was something which actually stopped my momentum. And especially in my business line, there is lot high iteration rate. People leave very early, and that leaves me with lot of operations not taken care and all. So you need to invest in right people. You need to groom them, and you need to make them a part of your business. That's where you will succeed. A one person can't create enterprise. That's what my learning is as a founder.
I think, to your point, I know I've taken the step to hire an important person in my team, and then you invest in them, you provide all the training, and then all of a sudden, then you leave. And so then it creates additional angst to okay, do I want to invest? Do I want to train in someone else? Do I want to trust someone else? And then it's like you feel betrayed, and then it's like you don't want to give your baby over to someone else. So I understand, that kind of balance between finding the right person that's going to help give you momentum to move on to the next level, but then there's that level of trust that you have to have when you're building your team.
You raise a really interesting point there, and I think as founders, certainly from my experience, I'm good at certain things and I'm spectacularly terrible at other things, and I think having that honesty to look yourself in the mirror and go, right, I can do this stuff, but I'm a liability at this stuff. Yeah. So in putting together Pixie, I very deliberately wanted to bring somebody alongside me. Sarah Henwood is fantastic as CEO, and she's we call it the yin and yang. All the things I'm awful at, she's brilliant at, and some of the things, she wouldn't necessarily want to be sitting here right now with a microphone in her hand, and that's completely okay. So finding the right people at the right time and not hiring too early is almost the corollary of hiring too late. I almost brought in a CTO a year ago who, with the speed of evolution in technology at the moment, would have been completely the wrong person 12 months later. Yeah. So agility is also important, but I think honesty with yourself about being clear about what you bring and what you don't bring is a really important part of that hiring decision making.
I think what Richard pointed to and what you just said in terms of this hiring decision is not just the personnel that we have on the day-to-day operation, it's the governance, your board, the sophistication that the board has to develop as you go from A to B to C. That's a whole elevation of what's required, what's reported, because now you're reporting to other people, not just you. And you have to be accountable for all of that. So that it's not just the day-to-day people, it's the governance system that you have in place, and there's the reporting. There's no longer just your baby. Now this is everyone's baby.
Okay, our time is dwindling. It's so fast. I want to go to this next question. So we're moving from Series A to Series B, and I want to touch on organizational debt. Growth creates organizational debt. What is one crucial system or process you implemented to pay down this organizational debt and prevent internal friction from slowing down your growth momentum?
I haven't got to Series B yet.
Okay.
And Steve Covey in the 7 Habits of Highly Effective People said you want to begin with the end in mind. So I've literally set up my businesses so that we can go to an IPO.
Okay.
Now, when you do that, you need to understand what those processes are, what the people are, the right sources of people, and debt ratio is going to play a major factor in how investors feel confident. There's going to be investors that want to come in for a short term, maybe 3 to 5 years, and they want out. And they want to see the ability that you're able to retire that debt, get them their money back, and still be able to scale. Then there's other investors that want to be in there for the long term. And again, it goes back to what your end goal is. And that's why I think even at the seed stage, you want to have a plan of what you're projecting in the near future.
Okay. Does anyone else want to add?
I was going to ask you a question, if you don't mind, because I think there's a sort of matrix effect going on here, in that I think investors want to know that you're grounded, that you know what's happening next week and next month and next quarter, but also have your eyes on the prize at the same time, and it's how you balance the ability to speak to the big future. That, I mean, most VCs really want you to 100x their money. Very few businesses actually 100x returns for VCs. And
I can't hear you.
is that on? Oh, it's on now.
Yeah.
I'm not used to holding a microphone. So let me go back and rephrase what I'm saying there. So I think there's a couple of components here. There's the investors want to see that you and your team have got you've got control of the business as it is now, and it's got a cadence to it that's realistic and active. But at the same time, have eyes on the prize, because VCs want to see 100x on their money, and so few businesses do, that you have to make sure that you're on that trajectory as well. How do you sort of balance that assessment of a team when you look at investing to see whether they've got that mix of practical operational capability as well as the visionary sense of growing a business of substance?
It's for me? Okay. I thought it's for you.
I'm sorry.
What exactly when investor is looking at different stages at you is like completely different. And when he said that I have not gone to Series B, if I have to see it from a founder's point of view, you don't have to honestly have all the round. Going to Series C is not a great thing. Okay, your own business should from seed should support Series A, and from Series A, your business should make that much sense to the market, or you should earn that much, that it is supporting themselves, So I am hoping, you don't have to go to Series B, and you are.
Right, go to see. That's what. Thank you for that.
So about because you are a founder and you started with something maybe exceptional or innovation, or and your idea has that kind of merit. It's very important, I feel, at first level, investor is looking at the vision, and at the different, after that he starts looking at what kind of money you are going to make for them.
Yeah.
So you need to understand that aspect very well. You need to understand your investor's interest very well, and you need to convey him that way. Okay, you need to speak him that kind of language, because he is here as an investor, and he is going to ask you every day, what is your progress? Are you, giving my money back with whatever returns I am expecting? So that kind of communication is very important to the investor.
I think that's an absolutely genius point. It's with everything that happens, all the rock and roll that goes with scaling the business, and as you get into, Series B is a whole world of pain. Trust me, you don't want to go there. But you must always remember what it was that got you going in the first place. This germ or this spark of an idea that's what lit this up. It's often, it's so easy to get that lost in traffic. There's so much going on, and to just take a breath occasionally, look in the mirror and go, what was it that got me doing this in the first place? What is so exciting about what I'm doing that made me get this far? Because it will be that energy that propelled you to this stage. And I think it's so important to not forget that as the world becomes more complicated.
I love what he just said. Even at the seed stage, investment is made on that passion and fire that the founder has. But that doesn't go away because they want to see that at every stage. And you pointed out something, I like what you said, that I don't have to go from C to A. I could go from C to C. I like that. And we're going to go C to C. Okay, so, but the ideal is that I have to have a vision that's bigger than everybody else that they can see. And my job as the founder is to paint that picture so they can see possibility and opportunity. People will invest in opportunity that makes a difference.
I would like to add here,
Okay,
one
and
small
while
point.
you're talking, go ahead, and we're going to have everyone just to go ahead and leave us with a tip or resource that we can use.
Okay, I will just add to his point. Like, I understand, it's very important because all the great ideas start with that passion. But at certain level of business, we have to, there are a lot of businesses which failed because we were over passionate and we overlooked lot of, business sense from the passion. Mm-hmm. So investor here is not, he is looking at us after Series A, they are just looking for the returns. Mm-hmm. And founder is well passionate. Mm-hmm. But you need to balance it out, mm-hmm. not going over, because until, if you want to scale that business, it should make the, financial sense from your passion. So I feel it's very important to grow big, or, all the companies who have, achieved from seed to, they have balanced the investor's vision and the founder's vision, because both come from a different mindset.
Yes.
So that's very important, and that's what I feel, we should take care of.
Okay.
I agree with everything she just said. My thing is that I've assisted other people going from seed to Series C. And one of the things that I discovered, there are founders that won't let go. Yes. They don't have an exit strategy. The ideal of business, in my view, is you build value. And you have three things you're looking for. You build a value in such a way that somebody wants to purchase you.
Right.
Or you build a business in such a way that people want to partner with you. Or you build a business in such a way you go to IPO. Either way, you get paid. And what you created creates possibility for other people, and you have to balance the quantitative with the qualitative to make sure the investors are satisfied.
Last comments, last remarks, Richard?
It's like being on the Oscars. You're going to get taken off. I'm out of time. I've got one quick thing to say, and I just want to say it to everybody here. Actually, I think we must remember as founders and as people who invest in founders that what we're doing requires is an act of courage, yes. and I think we need to take occasionally time just to celebrate ourselves and to remind ourselves that. As I think somebody once said, we choose to go there not because it's easy, we're choosing to go there because it's hard. And realizing a vision is hard, and it is a journey. And I just want to say to everybody, including my fellow panelists, thank you for the time that you've spent with us this morning. I hope it's been helpful.
All right, everyone, let's just give our panelists a hand of applause. They did a really good job. I know it was interesting to me, and I think there's nothing more fulfilling is when someone, a stranger, does put money behind your mission and vision. I sit back and look at, sometimes I'm like, oh my gosh, I can't believe I had someone to invest in my mission and vision. And so we just encourage each of you to continue the process, keep going and keep opening up businesses. And if you want to continue this conversation with us afterwards, you can meet us out there in the lobby area, and we'll continue to network with you and collaborate with you on your business ideas. Thank you, everyone.